Welcome to the Deep Dive, where we take your sources and turn them into clear, actionable insights. Today, we're embarking on a pretty deep fundamental analysis of a company that really sits at a crossroads. Eos Energy Enterprises, Inc., trading under the ticker EOSE on the NASDAQ. And this one, well, it reveals a company with a truly binary outcome. It could be a massive energy grid disruptor or, frankly, a cautionary tale. There's not much in between here.
That's exactly right. Our mission today is basically to cut through the noise, look at an in-depth report on EOSE, and pull out the most important nuggets of knowledge. We've dug into their business model, the management team, financial health, market position, risks, all of it. So you can quickly get up to speed on this pretty captivating company. We'll break it down into 7 key chapters.
Okay, so we'll start by unpacking the core stuff, the business, management, and financials in the first part. Then we'll switch gears, delve into market sentiment, ownership, the critical risks, and wrap it all up with a synthesis and outlook in part 2. Before we dive in, though, a quick word from our partners. Like and subscribe to Stock Analytics AI. Members get priority deep dives on tickers, and look, over the next few months, they're covering all of the S&P 500 stocks. For just $4.99 a month, members get exclusive priority access, and if you just want a one-off deep dive, drop a super thanks. All right, let's get started with Chapter 1, Business and Industry Analysis. The central question here, the one EOS is basically betting its entire future on is, can an American-made zinc-based battery tech truly disrupt the lithium-ion empire? Can it power the future of energy independence?
It's a huge question. So Eos Energy Enterprises, EOSE, they're an innovator in battery energy storage. Our analysis is current as of July 22, 2025, and shares closed at $6 yesterday, July 21st. This is all based on publicly available info. Fundamental look, their mission: accelerate the shift to American energy independence. And they do this with a vertically integrated business model.
Vertically integrated meaning?
Meaning they handle pretty much everything: design, sourcing, actual U.S.-based manufacturing, and providing their own proprietary zinc-based battery energy storage systems, BESS as they're called.
Got it. And how do they make money?
Primarily through direct sales of these DC battery systems. They sell to utilities, independent power producers, renewable developers, industrial clients, a pretty diverse group. Their sweet spot, or what they focus on, is mid to long duration applications. Think 3 to 12 hours of storage. That's where they believe their zinc tech really has an edge. And beyond just selling the batteries, they offer support services across the project lifecycle.
Okay, and the tech itself, you mentioned zinc.
Yeah, the core is their proprietary Eos Znitha aqueous zinc battery technology. It's protected by, get this, over 122 patents. This tech forms the basis of their Eos Z3 battery module. And from that module, they build different solutions. There's the Eos Cube, that's a containerized unit, sort of plug-in power for quick outdoor setup, and the Eos Hangar for really big utility-scale projects needing maximum capacity. And interestingly, the Eos stack, they call it a market first for safe indoor energy storage, thinking about urban areas. And all these solutions come with their own Eos battery management system software, the BMS.
So they're targeting that mid-duration storage market, 3-12 hours, helping with grid stability and renewables integration. You said they're scaling up.
They are. They're still in early commercialization, relatively speaking, but scaling fast. They hit record quarterly revenues of $10.5 million in Q1 2025. And their opportunity pipeline, what they see as potential future business, is a massive $15.6 billion. But their market cap, around $1.49 billion, is still pretty small.
Right.
It really reflects market anticipation, hope for future growth, not so much current earnings. And a big part of that future is Project AIM-AV, their manufacturing expansion, which is getting significant backing from a U.S. Department of Energy loan.
Right. The DOE loan is huge validation. Let's talk about their value proposition. Why choose EOS over, say, traditional lithium-ion?
That's key. They're hitting on several points. First, safety. They use a non-flammable, non-corrosive aqueous electrolyte, basically water-based. This massively reduces the risk of thermal runaways, those dangerous battery fires. They've got the UL 93540A certification, which is a big deal for safety.
Okay, safety is a major selling point. What else?
Second, sustainability and supply chain security. Their batteries use low-cost, abundant materials like zinc. No lithium, no cobalt, no nickel, none of those materials with complex, sometimes problematic supply chains. Plus, being manufactured in the USA is a big plus for security and appeals to certain customers and policies.
Makes sense. Performance.
They claim strong durability and performance. We're talking a 20-plus year operational life, keeping 88% capacity over that time. They can handle 100% depth of discharge and work across wide temperature ranges.
And the cost. That's always critical.
Right. Their final point is lower lifetime cost, or LCOS. They claim it could be up to 25% lower than comparable lithium-ion systems over the battery's life. A big reason for that is they don't need expensive fire suppression systems or heavy-duty HVAC for cooling. Plus, the materials are apparently cost-neutral to recycle.
Okay, that's a compelling package, at least on paper. What about the industry itself? Is the market there?
Oh, the market is definitely there and growing rapidly. Global energy storage is exploding. Projections are like 21% compound annual growth through 2030. The U.S. market saw record installations in Q1 2025, mostly utility scale. And crucially, there's this growing trend, uh, increasing attention being paid to alternative battery chemistries. You see entities like the New York Power Authority exploring zinc-air tech, specifically because of safety concerns with lithium-ion. That's a tailwind for companies like Eos.
But they're not alone in this space, right? Competition must be fierce.
Absolutely fierce. They're in the broad electrical equipment industry. They face the big lithium-ion incumbents like Fluence Energy. They face other alternative chemistry developers, other zinc companies, flow batteries, you name it. And then you have diversified energy giants potentially moving into the space. Eos is really what you call story stock. Its valuation isn't based on today's numbers. It's all about the future narrative.
And the numbers today, you mentioned they're tough.
Very tough. That price-to-sales ratio, PS, is sky-high at 87.48 on a trailing 12-month basis. The industry average is more like 5.5. And the gross margin, TTM, is negative 442.77%. It costs them vastly more to make the product than they sell it for right now. That's the core operational challenge.
Wow. Okay. And regulation, you mentioned the DOE loan, the IRA.
Yeah, the regulatory environment is a powerful but double-edged sword for them. On the positive side, the 2022 Inflation Reduction Act, the IRA, offers huge incentives. Investment tax credits for their customers, production tax credits for EOS's own U.S. manufacturing. Massive tailwinds. And that DOE loan program's office support isn't just capital, it's huge third-party validation. But the flip side is risk. Political uncertainty around the IRA continuing in its current form is a threat. Broader trade policies like tariffs on Chinese goods could be complex, maybe helps competitively, maybe disrupts their own supply chain bits. It's complicated.
And just getting into this business must be hard. What are the barriers to entry?
They're substantial. First, technology and IP. It takes years of R&D. EOS's 122-plus patents are a real barrier. Second, it's incredibly capital-intensive. You need hundreds of millions, potentially billions, to build gigawatt-hour scale factories. EOS's own journey shows that. And third, manufacturing and supply chain expertise. Just having a factory isn't enough. Running it efficiently, getting high yields, that's an operational mode in itself.
So summing up their advantages.
Okay, competitive advantages. They're building a strong brand, made in the USA, safe, sustainable. That resonates. They have theoretical cost advantages with that lower LCOS claim, but that entirely depends on achieving massive economies of scale to fix their current negative gross margins. There's a network effects or switching costs. Once a customer designs a big project around your specific chemistry, they're likely to stick with you. And unique assets, their proprietary IP, that U.S. factory in Pennsylvania, and the crucial DOE validation, which I think connects nicely to the people running the show. Let's move to Chapter 2, Management Evaluation.
Right. Who's steering this ship? It sounds like they need experienced hands.
They seem to have them. The leadership team includes seasoned executives from energy, industrial, and financial backgrounds. The CEO, Joe Mastrangelo, spent nearly 3 decades at General Electric, involved in large-scale energy projects. That's serious experience. The board is also stacked. Chairman Russ Steidoff comes from Alt Energy. Director Jeff Bornstein is a former GE vice chairman and CFO. Importantly, he helped navigate GE through the 2008 crisis. And you also have representatives from Cerberus Capital Management on the board, which, as we'll see, is a huge factor.
Okay, experienced leadership. Have they been tested? How have they handled crises?
They definitely have. Management has navigated some incredibly tight financial spots. They've executed complex financing deals like a $336 million offering just last month in June 2025. And critically, they successfully met 15 out of 16 performance milestones tied to that very stringent Cerberus financing facility. Missing those could have been catastrophic, so hitting them was vital for continued funding.
What about communication and ethics? Are they transparent?
They maintain pretty regular communication with the market, press releases on financials, milestones, new orders, that kind of thing. They also emphasize their commitment to ESG principles, which aligns with their product safety and sustainability profile and the domestic supply chain focus. And having such a high-profile board generally suggests strong governance oversight.
Any red flags from insider transactions? Selling stock?
Well, there was a recent sale noted. The chief commercial officer, who was also interim CFO, sold about 47,000 shares in early July 2025. There was also a CEO filing around the same time. Now, these are often related to restricted stock units, or RSUs, vesting, basically, shares granted as compensation becoming available. Often, insiders sell some just to cover the associated tax liabilities. So it's not automatically a red flag, but you definitely want to monitor for any significant pattern of open market selling that isn't clearly tied to compensation plans.
Makes sense. And how are they using the capital they do raise? What's the allocation strategy?
It's laser focused. It's all about funding organic growth by scaling the core business, specifically Project AMAZE. No M&A, no diversification. It's really a strategy born of necessity. They have to scale to survive and reach profitability. Minimum viable scale is the goal.
And things like dividends or share buybacks?
Non-existent. EOS doesn't pay a dividend, no history of buybacks. And that's completely appropriate for a company like this, pre-profitability, high growth, needing every penny for reinvestment. In fact, they're doing the opposite, issuing new shares and convertible debt to raise cash, which, dilutes existing shareholders. It's the cost of survival and growth capital for them right now.
Okay. What about return on invested capital, ROIC?
Yeah, ROIC is currently deeply, deeply negative. They're investing huge amounts of capital but aren't generating positive net operating profit yet. So as a current metric, it's not very useful. The whole investment thesis hinges on the potential future ROIC if, and it's a big if, they successfully scale up. The bull case assumes they'll generate high returns once manufacturing is optimized and those unit costs come down. So the key thing to track for future ROIC potential isn't ROIC itself right now, but improvements in that gross margin. That's the leading indicator.
Okay, here's where it gets, as you said, really intense. Let's dive into Chapter 3, financial analysis.
Right. Let's start with some key metrics. Market cap is around $1.49 billion, so it's a small cap stock. And incredibly volatile, the stock price is up something like 344% over the past year. That screams speculative investment. Revenue growth, well, it's been a bit of a roller coaster. Explosive growth from a tiny base initially, $6.2 million in 2020 to nearly $18 million in 2022, but then it declined in 2023 and 2024. The trailing 12 months revenue, TTM, as of Q1 2025 was $19.46 million.
Why the recent decline after that initial surge?
Management attributes it to a strategic transition, focusing on their newer EOS Z3 product and maybe timing things to maximize benefits from the IRA kicking in. But it makes their 2025 revenue guidance of $150 million to $190 million incredibly high stakes. They need a massive ramp up this year to hit that.
Okay. And profitability. We touched on the gross margin.
Yeah, all the profit margins are starkly negative. That gross margin TTM at NAGIS 442.77% is the headline number. Costs just dwarf revenue. That's the biggest hurdle, period. Operating margin is nagging a 911%. Net profit margin is an eye-watering NAGIS 4,225%. The only silver lining, and it's crucial, is that gross margin did improve by 93 percentage points in Q1 2025. They cited higher volumes and lower costs for the new Z3 battery. That trajectory, whether they can keep improving that gross margin, is arguably the single most important financial indicator to watch.
And free cash flow. Are they burning through cash?
Oh, yes. Consistently and significantly negative free cash flow. Cash burn is high. Fiscal year 2024, they burned through about $187 million in free cash flow. FY 2023 was about $174 million. Their survival, frankly, depends entirely on accessing external capital. Before their most recent financing round, estimates put their cash runway at only about 6 months. They are constantly needing to raise money just to keep the lights on and fund operations and expansion.
So overall financial stability sounds precarious.
That's a good word for it. Earnings consistency. Well, they consistently post substantial net losses.
Yeah.
That huge $685 million net loss in 2024 was impacted by some large non-cash charges, things like changes in fair value of warrants and stuff. And even the reported net income of $15 million in Q1 2025 was driven by accounting adjustments, not underlying profitability. Their adjusted EBITDA, which is closer to operational cash flow, was still a $43 million loss in that quarter. You really have to focus on the cash-based metrics here.
What about debt?
The debt-to-equity ratio isn't even a meaningful calculation because they have negative total stockholders' equity. It was negative $431 million in Q1 2025. That's a really severe indicator of financial distress. Total debt stood at about $325.5 million. Servicing that debt depends entirely on raising new capital. And this situation is serious enough that their auditors issued a formal going concern warning.
A going concern warning. That sounds bad.
It is. It's the auditor basically saying there's substantial doubt about the company's ability to continue operating for the next year without securing additional funding. It's a major red flag. Now, their current ratio looks okay on the surface, around 2.05. But you have to be cautious that's likely boosted by recent cash infusions from financing, not from cash generated by the business. That cash can disappear quickly with their burn rate. And obviously, dividend stability isn't applicable.
Okay, so the financials are challenging. How does the market even value this company?
Valuation is tricky. Relative valuation, like the PE ratio, is useless because earnings are negative. Price to sales, PS, is, as we said, exceptionally high at 87.48 TTM, way above the industry average of 5.46. This clearly shows the market is pricing in enormous optimism about future growth. Trying an intrinsic valuation using discounted cash flow, DCF. For EOS, it's highly speculative. It completely depends on making long-term assumptions about if and when they become profitable and how fast they grow. The model spits out an extremely wide range of potential values. It's more of a scenario planning tool here than a precise valuation method.
What are the key assumptions driving those DCF scenarios?
Things like the discount rate, their weighted average cost of capital, or WACC, is likely quite high, maybe 11–13%, reflecting the high risk. But the most sensitive assumption is the free cash flow break of year. When do they actually stop burning cash? Pushing that date from, say, 2027 to 2029 can drastically change the calculated value. And of course, assumptions about long-term revenue growth rates and eventual profitability margins are also huge drivers. It's all about predicting a future that's very uncertain right now.
Okay, let's shift gears into part 2. Let's unpack chapter 4, market sentiment. How is the market actually perceiving EOC?
It's really mixed, reflecting that binary outcome we keep mentioning. If you look at analyst price targets, the consensus is a moderate buy. Notably, there are no outright sell ratings, which is interesting given the financials.
But within that moderate buy,
There's an exceptionally wide range of price targets. We're talking from around $4.07 on the low end, maybe from someone like TD Cowen up to $9.45. Maybe Stifel is more bullish, around $8.50. The average target sits somewhere around $6–7. That huge spread really signals the different ways analysts are weighing the potential versus the risks. It's a sign of profound disagreement or uncertainty about the future.
and how does news affect the stock? You mentioned volatility.
Oh, hugely. It's very reactive. It's like a tale of two conflicting stories playing out in the headlines. Positive news. The DOE funding announcement, hitting milestones, announcing a big new order that can cause the stock to surge dramatically. But then negative news, missing sales guidance, reports of supply chain hiccups, dilution from financing, analyst downgrades that can hammer the stock just as quickly. It creates a really choppy, volatile information environment for investors.
Are there any specific market indicators we should watch?
Yes, one stands out dramatically. Short interest, it is exceptionally high. We're talking 34.64% of the float is sold short. That's about 85 million shares. This makes EOS a classic battleground stock. Bulls betting on the future, bears betting against its survival based on current financials. The days to cover how long it would take short sellers to buy back all those shares based on average trading volume is around 5.5 days.
So with that much short interest, potential for a short squeeze.
Exactly. There's significant latent potential for a short squeeze. If some major positive catalyst hits like significantly better than expected results or a huge strategic partnership, it could force those short sellers to buy back shares rapidly, driving the price up even faster. It adds another layer of volatility. Also, technically, the stock crossed above its 50-day moving average recently in mid-July, which is often seen as a bullish short-term signal. It's likely trading near or above its 200-day average too, given the run-up over the past year. What's also fascinating here is who actually owns the stock. Let's look at Chapter 5, ownership structure.
Right. Who are the major players holding EOC shares?
There's significant institutional ownership. Estimates range from about 37% up to maybe 55%. You see the big passive index funds, Vanguard, BlackRock, which provides a stable base of demand just from index tracking. But you also see active or thematic funds like Electron Capital who are making specific affirmative bets on EOS's technology and future.
And you mentioned Cerberus Capital Management earlier.
Yes, they are arguably the most influential stakeholder, period. Their involvement is way beyond a typical investor. They provided absolutely critical financing when EOS was on the brink. They hold board seats. And on an as-converted basis, considering warrants and convertible debt, their potential ownership stake is huge, around 41.2%. Their continued support is essentially a lifeline for the company right now. Monitoring anything related to their position, even historical exits from other investments, is important context.
What about insiders, management, and employees?
Insiders hold a relatively small piece, maybe 2.5% to 3.6% of the company. We mentioned those recent sales by the CCO interim, CFO, and CEO in July, again likely tied to RSU vesting and taxes. The key thing to watch isn't necessarily those program sales, but any large discretionary open market selling by key insiders. That would be a much bigger concern.
So overall, how concentrated is the ownership?
It's highly concentrated. Cerberus's potential 41.2% stake gives them immense influence over the company's direction and future financing. The top institutional holders also control a significant chunk. This means the stock's price can be heavily influenced by the decisions of just a few large players, and add to that a high level of retail ownership, which often contributes to volatility.
Okay, so putting it all together, the business, the financials, the market, the ownership. Let's synthesize this with Chapter 6. Risk assessment, maybe using a SWOT framework. Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start with the strengths, the core internal competencies EOS has. First and foremost is their differentiated and patented technology, that aqueous zinc chemistry offering safety and sustainability benefits. Second, their U.S. manufacturing base in Pennsylvania. That Made in America angle aligns with policy incentives like the IRA. It is a strength. Third, strong government and strategic backing, the DOE loan validation, and the deep involvement of Cerberus are critical strengths. And fourth, that experienced management team we discussed, with deep industry backgrounds, particularly from GE.
Okay, those are compelling strengths. Now for the painful part, the weaknesses, the internal limitations.
Yeah, and they are severe. Number one is severe unprofitability. Those deeply negative gross, operating, and net margins are a massive weakness. This leads directly to number two, high cash burn and financial distress. Persistent negative FCF, negative shareholder equity, that going concern, warning it's a precarious financial state. Number three falls logically. Dependence on external financing. Their survival hinges on the mood of the capital markets. And finally, lack of manufacturing scale. Profitability is entirely dependent on successfully executing Project EOSE and getting costs down, which they haven't achieved yet.
Right. Now, looking outward, what are the opportunities?
The opportunities are potentially huge. First, the massive and growing market for energy storage, driven by renewables and grid modernization. It's a secular growth trend. Second, favorable government policy, especially the IRA, provides powerful tailwinds and incentives. Third, the manufacturing expansion itself, Project MA's succeeding, represents a massive opportunity to fix their cost structure. And fourth, that potential market shift away from lithium-ion due to safety or supply chain concerns. That creates a significant opening for alternatives like EOS.
And to complete the SWOT, the threats, the external challenges they face.
These are also significant. First, intense competition. They're up against huge, well-funded lithium-ion incumbents and a swarm of other alternative chemistry developers. Second, technological obsolescence. Battery tech moves fast. There's always a risk a new, superior chemistry emerges. Third, the impact of key macroeconomic factors. High interest rates make capital more expensive for EOS and their customers. Inflation affects costs. A recession could slow project development. And finally, the impact of specific geopolitical factors. The risk of the IRA being repealed or significantly altered is a major threat. Tariffs and trade wars could also disrupt things unexpectedly.
Okay, that SWOT analysis really lays out the battlefield. So this raises the crucial question. Let's get to Chapter 7, conclusion. How do we synthesize all of this?
Yeah, the bottom line is that EOS is at an absolutely critical juncture. It presents a starkly binary investment case. The arguments for and against are both incredibly strong.
So let's summarize the bullish points, the bull case. What's the story if everything goes right? The bull case focuses on that forward-looking narrative. You have disruptive and arguably de-risked technology solving real problems with lithium-ion, safety, supply chain. You have a massive policy-driven market undergoing exponential growth, boosted by the IRA and validated by DOE backing. You have credible backing from Cerberus and an experienced GE-heavy management team. And you have a clear path to scale via Project EOSE, which, if executed well, could lead to profitability through significant cost reductions per unit.
Okay, that's the dream scenario. Now, the counterargument, the key bearish points, the bear case, grounded in today's reality.
And this case is equally compelling, maybe more so based on current facts. First, precarious financial health, deeply unprofitable, burning cash rapidly, negative equity, the going concern warning the financial situation is dire. Second, immense execution risk. The entire bull case relies on a flawless manufacturing ramp-up with Project EOSE. Given past challenges and misses, that's a huge uncertainty. Third, extreme shareholder dilution and dependence on capital markets. They will need more money, likely maybe more dilution for existing shareholders, and they're reliant on markets being willing to provide it. And fourth, formidable competition from lithium-ion giants and other tech, plus that significant policy risk around the IRA.
And the valuation summary again?
The DCF modeling, as we said, produces an extremely wide range of potential values. It's highly sensitive to assumptions about when profitability occurs and how much they grow. It's really a scenario modeling exercise reflecting that binary, almost venture capital-like risk profile. Don't look for a single precise intrinsic value number here.
So the concluding outlook, what's the takeaway for someone considering EOC?
Eos Energy Enterprises essentially represents a venture capital style investment, but one that happens to be available on the public markets. The current share price, around $6, reflects a market trying to balance that compelling long-term vision against a very perilous near-term reality. It's fundamentally a probabilistic bet on the future succeeding against long odds, not an investment based on current earnings or stability. The potential upside, if they navigate these challenges, is substantial, no doubt about it. But the risks of failure, dilution, or even bankruptcy are equally substantial. The path to profitability is incredibly narrow and fraught with operational, financial, and market challenges. The outcome really does feel like it will be boom or bust, with very little middle ground.
So here's a final provocative thought for you listening. What does it really mean to evaluate a company where almost all the value is tied up in future potential, not present financials? How do you weigh truly transformative technology against such significant financial distress and that immense execution risk? It's a fascinating puzzle for any investor.
And that wraps up our deep dive into Eos Energy Enterprises. We certainly hope this exploration has given you a much clearer picture of both the incredible opportunities and the significant challenges facing Eos. Remember to like and subscribe to the Stock Analytics AI YouTube channel. Members can suggest stocks for future videos right there in the comments, and we'll prioritize those for deep dives.
And as always, please remember this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. You should always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll be back soon to unpack another fascinating topic.